Good morning, everyone. Today we're looking at GBPUSD on the 4-hour chart, which hits a wall at 132.75 on Monday and has since pulled back after, of course, forming a double top and um, a divergence on the RSI. But here's the key. This doesn't look like a reversal setup for me, at least for now, because we are trading above the 38.2 Fibonacci of the longer term leg, and that has formed resistance support. Well, we watched resistance at some point, right? But we are now back within this territory, which suggests that perhaps we are, and we should be looking at this as an 1-2-1-2. Well, it could be an ABC as well, or or in 1-2. It's irrelevant at this point. What I'm referring to is that this is what we're probably looking at here. Okay, so let me explain. We've had a double top here on Monday, right? And prices immediately reversed to close down to around the 132 handle. So this pullback first was a classic profit taking reaction after what has been called the Rachel rally following the UK budget announcement, of course. Sterling had surged over 1% last week. And that was because, of course, the budget didn't really blow a hole in the public finances. Traders who bought the budget relief simply cashed out at the resistance level. Now, markets are pricing a 90% chance that the BOE is going to cut rates on December 18. And this is, of course, creating some headwinds for sterling. But here's the bullish case. Fed rate cut expectations have surged to around 90% for December. And yesterday we also had weak ISM data in the US, the ninth straight month of contraction. Yes, both central banks are cutting, but the dollar is under more pressure right now. That's supportive for cable on pullbacks. So I'm looking at pullbacks as opportunities to buy. The one scenario, actually, I should be drawing this from there to there because we're looking at this as an internal structure correction, right? We have this supposedly 5 wave leg to the upside, and we're now expecting a wave 2 correction that would uh, could complete wave 2, a corrective pullback. The area that we'll be looking to hold is between the 38.2 and the 61.8 Fibonacci extension. This is a short-term pullback. This is more of a corrective leg, but losing the 61.8 at 130 to 130 currently, it's going to increase the chances of prices just simply continuing lower, and we would mark this as a corrective wave with the false break or weak attempt to break out this base channel. If, on the other hand, we do see this range hold or higher levels, then we would be looking at this as an acceleration move, right? And instead, we'll be looking to draw a new channel with the new low. If we drew that, of course, now we would be looking at this particular channel. We have broken below that level now, and we could go lower down. How I would be playing this, I would be looking for currently, if we are the 1 and the 2 and the 3 and the 4 and the 5, supposedly, this is probably A and B and C, a likely flat. We could see that even the 132 holding. Okay. But how I would play this in terms of channel, I would be looking at connecting the 1 and the 3, and then the 2 again comes down there. And then we simply copy and paste that channel and we'll go one time lower. We are using the standard deviation technique here to see where prices could eventually go. So I would be looking for something like the 131.50. We want that level to hold. Okay. Now, as I was saying before, if we manage to stay strong in this territory, I will be looking to take long positions. There is three ways of doing this. One would be going in at 132, aggressive. One would be to wait for pullback. Maybe you're going to miss the chance, but it's going to be a bit more confident trade. And we could be looking at, let's say, the 38 or the 50. But again, it's at the touch or at the candle close. Okay, it's always better to wait for the candle close. So let's just assume that we're going to 50. We'll be looking for a first target up at the previous high. Our stop loss will be just below the 61, between the 71 and the 61.8. And here's the best part. If this is indeed a continuation to the upside, right, then we would be essentially looking for prices to extend towards 1272, 1618. This brings us up to around 130.75 or so. Okay. And then if a wave three would be looking also at around 134.56. So our first target would be the previous high. Second target, perhaps the 272 or 38. Okay. The moment, of course, we achieve this target, we are going to come and place our stop at break even. And then we're going to let the rest, after the 1272, we're going to let the rest run, and we're going to place our stop loss. We're going to make it a trailing stop loss. Okay. Of course, this is the one scenario, and we always have to consider both situations because we have to go with where markets are pointing at every time. Okay, at every time is not possible, but so the alternative will be that we are going to lose, let's say, the 131.28, let's say 131. Okay, if we lose the 131, and most probably this is a corrective leg. Okay, and we'll be looking for a continuation to the downside. Typically what happens is we would see a break of this channel and the previous bottom in play. That would be uh, essentially the first target, but the short position would be played in, well, it would be a better situation to wait for a pullback after an initial leg to the channel. So we will be entering at 61.8 after that initial leg. Let me just make sure that I show you what I would be expecting, something like this. If that doesn't happen, we don't need to go in. It's okay. Our stop loss will be just above the 23.6. First target will be the previous low. And then in terms of the other targets, we will be looking to, well, there is different ways of doing this, but I would just be doing this by looking at the distance that we have just actually done as a corrective leg, right? So we'll be looking equally at 1272, the 161, and then perhaps even the 2. This is the sort of measured move equal leg of something like, the equality. So we'll be looking at 128.70 F47. And again, in a similar manner, we move our target to lower territories in this case. The first target is where we move to our entry point, and then the second target is where we start trailing. Okay, so we have these two scenarios. One is to buy the wave two, and the short-term idea is to actually sell the rally, pretty much. And that would be probably something like, if currently we don't see this continuation to the upside, they would look more like a longer term sort of wedge pattern. So something else we would have to pay attention if we do go short, if we fall lower, it would be, of course, hitting this essentially very, very important trend line related target. Okay. So bottom line, traders GBPUSD has pulled back from 132.75 due to profit taking on the Rachel rally. There is some sort of resistance there now. BOE is expected to cut, but also the Fed is expected to cut. And I'm looking at this as a wave two correction. So if 3130 holds, we're buying on the dip for wave three of wave three or wave three of wave C. Targeting 132.75, 133.15, and all the levels that we talked about. So watch your levels, remain nimble, and let the wave structure guide your trades. Drop your cable setups in the comments and make sure to follow for more macro plus technical trade ideas.